So good morning, good afternoon to all of you. So what we wanted to do with today was that I'm going to just start off by making a presentation on the impact of the basically a quick summary of the Africa Economic Update, which is primarily taking into consideration what has happened, what the impact of the war in the Middle East is doing on our economies, and then also just briefly talk a little bit about an issue on the second part of the report, which we haven't had a chance to discuss extensively in the public, which is about industrial policy. But primarily what I want to do is just use this as an opening space for you then to maybe give us an update. Remember, we had a meeting, an ad hoc meeting earlier in the year, soon after the war broke out, just to update each other about what was, how the impact of the war was evolving what the impact was evolving in our countries. But it will be good to actually get an update. So we will use this presentation as a mechanism for maybe updating each other, but also, of course, to give us back, a review and a feedback on this. But primarily, I want to also just point to you, the report is out now, if you haven't already seen it. So please take a look. There's a lot more information there than I can give in this short presentation, right? So that's the purpose of this meeting today, this webinar. Okay, so with that, it's up there. So this is sort of the headline story here. So what I want you to see is look at our 2026 bars, right? The year 2026. It's a forecast. And what this says is that, prior to the war, we were forecasting that growth in Africa was going to come in at about 4.4%. So this is sub-Saharan Africa, of course. Now that would have, for the first time, been the second fastest growing region in the world. It would have been growing at either at par with East Asia or higher than East Asia. The only other region that would have been growing faster would have been South Asia, right? So in that sense, you could say, finally growth is recovering. It's approaching what we were experiencing in the region, perhaps at the beginning of this century, between 2020, 2015 or so. But then, of course, the war happened. And now our focus is that the growth rate is going to come in at about 4.1%, which is the same as what it was last year, or what we are focusing for last year. Okay, so we're beginning, almost immediately there's a slowdown, right? Now, how deep or how large the slowdown is depends, of course, on what's going to happen in the Middle East. And there's a lot of uncertainty around that. There are several scenarios, and I'm just giving you about 3 here, which we've used to actually try and model for the path of the growth rate. Initially, we thought there's a possibility that the war will be short, swift, and it won't be nearly as damaging, right? So that's the swift resolution, where primarily we are assuming that, about 5 million barrels of oil per day would be taken off the market for 2 months. But then soon after that, it will get back to normal, and with minimal damage to the infrastructure. At that point, the assumption was that oil prices were going to go up to between 74 and 82%. $74 and $82 per barrel. And then natural gas will be around, it will increase by about $12 to $14 per metric tons. And then the increase in annual fertilizer prices will be about 20 to 25%, and so on and so on. We're way past that, okay? Then there is another scenario, the baseline, where 7 million barrels per day will be off market for 3 months. And then during the peak supply reduction, there is more, some kind of an offset from readily available alternatives. So, for example, like inventories that exist or storage that exists, by which we mean that even if, in fact, after 3 months, the war ends, the supply, starts resuming slowly, there will still be, by the end of the year, 1 to 2 million barrels that will be unavailable. Okay, at that point, prices will be around $84 to $96 per barrel. Natural gas will be about 15 to 25, and price, fertilizer prices will go up by between 25 and 30%. We are way past that. Okay, so now we are really in the protracted region, right? Where 9 million barrels per day are all out of market for 5 months, and this is almost the 75th day since the war started, right? Oil prices have been tapering at around 100 or more. So in this scenario, you can imagine, okay, so 5 months of disruptions, lots of distractions in the oil infrastructure. There will be, even by the end of the year, there will still be 3 to 4 million barrels per day that will be out of, that will not be coming into the supply. And that at that point, oil prices will be, over $100 per barrel, and natural gas will be anywhere from 30 to 40 per metric ton, and fertilizer prices will be 30 to 45%. All right, and we already see that. Sorry. So you can see here, for example, that this is a March. This is actually March, but even the updated one will not be that different from this one. You can begin to see already that oil prices. This is something we've all seen. You will see it. You see it in your countries. We see it around the world. Oil prices have skyrocketed. Fertilizer prices are, nearly all of them are above 50%, right? So that's the most immediate thing that you actually see, right? But I thought I would share this picture, because even though the most immediate thing you see in prices, there are actually consequences that are going to come that will follow the increase in prices that we have not yet seen, or we're beginning to see already, right? So this is a map that shows when the last shipment. Okay, so remember, there were a lot of oil tankers. There were a lot of ships that are carrying oil, fertilizer, whatever, that were in the Gulf before the war started. So they left the Gulf just before the war started, right? Before 28th of February. This graph shows when those ships would have arrived at their port of destination. Okay? So in Africa, so this big bubble that is circling, Eastern and Southern Africa, what that says is that the last ships that left the Gulf, okay, would have arrived at their ports of destination around the first week of April. After that, there's really little that is coming out of the Gulf. Okay? April. So imagine that. That's almost a month and a half ago. So once those shipments are exhausted, they arrive at the port, they're into the market. Once they're exhausted, then the other supplies is, the only way for these countries to get their supplies is to go out in the spot market and try and get it from alternative sources. And of course, everybody's scrambling to get it from alternative sources, right? Whether that is, from Brazil or from the US or from, West Africa and so on, right? So you can imagine what that means. That means is you are likely going to lead to a destruction of demand or lots of shortages. right? So that's what this graph is basically showing, right? So in East Africa and Southern Africa, it would have arrived, the last shipments would have arrived in April. In Europe and East Asia would have been about a week later. And then by middle of April is when the last ships that left before the war, that left the Gulf, would have arrived in North America, right? And after that, then it is, everyone is scrambling to get oil from somewhere else. So there is some real consequences, not just in prices, but also in physical availability of these things. But that's not the only, so prices are not the only ways in which, of course, the war is affecting African countries. One is investments. The second is investment. So, the Gulf countries have turned out to be some of the major investors in Africa, right? Particularly Eastern and Southern Africa, but all over Africa. They're investing in, real estate, they're investing in mining, they're investing in fintech, in tourism, you name it, right? Agribusinesses, there are all kinds of sectors where these countries have poured a lot of investments in. And this is important, right? Foreign direct investment is very important for a region that desperately needs investments in order to actually create jobs for a very large working age population that is growing. So imagine, so UAE alone, for example, had at some point become the largest investor, actually, the largest source of foreign direct investment in Africa, larger than China, larger than Europe, larger than the US. But if these countries start turning internally for reconstruction, you can imagine that maybe a lot of those investments are either going to be canceled or delayed. Okay, so that's not great for the region. There are also a lot of Africans that work in the Gulf. And so remittances are a major source of income for households to meet their usual needs in education, in health, in food, and so on and so on. And of course, down the road, with fertilizer and fuel prices rising, you can expect, for example, that the central banks are going to act. And they will increase, interest rates. That was the most responsible thing to do in order to reduce inflation. And then, what you will begin to see is that the currencies will begin to, as that happens, the currencies might weaken against the dollar, and then you begin to see another inflationary pressure coming in from there. And, so there is this sequence of things, prices, and maybe followed by, output reduction, followed by potential, shortages, and then maybe, down the road, potentially financial pressures. All these, when you put them together, will lead to things like job losses, food insecurity, and increases in poverty. And what we did, is basically, and you will see this in the report, is to think about scenarios where inflation, for example, might increase to what we saw during the Ukraine war, right? In which inflation in some cases rose by about 4 percentage points. And then think about, okay, so if that was to be the case, or different kind of scenarios, plus you take into consideration the fact that remittances are going to be declining, there could be potential job losses. So how much poverty are we likely to see? So you can see here, for example, that already just the first 2 months of the war, inflation has actually gone up by 1 percentage point on average in Africa. And in a bunch of countries as of now, that has gone up by almost 2 percentage points for some countries. That they were in 3.5 and now it's 5 point something, right? So it continues to go up, and the longer this goes on, again, even inflation is actually uncertain, right? We don't really know how long this will go on. So even the how quickly inflation will accelerate is uncertain. But in any case, so we did some estimates, and what you see on the right-hand side is just the potential number of people who will be forced to fall into poverty. And for some cases, quite serious. So in a place like Kenya, you could potentially see 1 to 2.4 million people falling into poverty. In places like Cameroon, you could see 200,000 to 300,000 people fall into poverty, depending on certain scenarios. In Senegal, could be up to a maximum of 600,000, right? So it's not trivial. So these are just some examples, but you could do this for a whole bunch of countries. And and then this crisis couldn't come at a worse time, right? When COVID hit, African countries still had some level of fiscal space, which they have built over the first 2 decades of the century. So right now, they don't have any fiscal space. More than half the countries are in debt distress or at high risk of debt distress. And even though debt levels have stabilized in the last couple of years, although at a higher level, so 55% of GDP. So they've stabilized. They're no longer increasing. That is in danger, right? For a number of countries. That stability is now going to be is coming under pressure. But what hasn't stabilized is debt servicing costs. Because of all the stock of debt that has been built up that now need to be paid, debt servicing costs have actually doubled between 2017 and 2025. So many countries now are spending at least 18% of their revenues on servicing debt. That's a lot of resources that cannot be used to actually respond to this crisis at the moment. So the region is in a very precarious situation, and unfortunately, they don't have the means to actually protect themselves as adequately as they would like to. Now, having said that, all is not bleak, and we shouldn't basically try to imagine a catastrophe all the time. This graph is just an extension of what I've just said, which is, this table, which is what we did was to look at, we looked at countries and looked at several things. We looked at, first of all, exposure to a lot of these shocks, and then the policy space that's available, right? So this is to say that even though, in fact, the region on average seems to be facing these challenges, there's going to be a lot of diversity in how countries are going to be affected. There's a lot of heterogeneity in how countries are affected. And so that a lot of that depends on the exposure, and then, of course, the policy space that they have. And what you see here is, first we look at trade exposure. So, what is the share of oil and gas imports as a percent of GDP as of 2024? That's the exposure. Food net imports as a percent of GDP in 2024, because that's the latest data that we can have, and so on, right? Fertilizer imports that come from the Gulf, remittances as a percent of GDP, and so on, right? So what you see here is the green means that you're in good shape, right? Your exposure. So, for example, the negative numbers in green basically suggest that these countries are oil exporters. So they're gaining instead of losing, right? So anything green that suggests that you're in better shape to either on the exposure side but also on the policy space. If you're in yellow, you're worse than the green, but not terribly bad. Okay, the pink, is it pink? Whatever. So that is when you begin to see now the exposure becoming to be a bit more of a strain. And of course, the purple is the worst, right? That is, extreme exposure in the negative sense, right? So you can look at every country here. So this is Eastern and Southern Africa. You can look at every country here and begin to see, okay, which of these countries, when you look at the exposure, but also on the policy space, are going to come under a lot of pressure and actually going to be under a lot of stress, right? So that's just what this table basically shows. And you can do the same thing for Africa, into Western and Central Africa. And you can already begin to see, some of these countries where oil and gas exports are like really large in terms of as a share of GDP. So, Mauritania is like among the top. Liberia is another one. And then you can see, for example, the government effect, not the government, something like government debt is, 52%. Mauritania's government debt is not that much. So maybe in that sense, they have maybe a little bit of a policy space to borrow. Their reserves are in good shape, right? They have 6 months of, foreign exchange for 6 months of imports and so on, right? So you can see, if you look at these tables, you can see which countries are really, really heavily exposed, but also don't have, in a negative sense, but also don't have a lot of fiscal space, right? And so you can find your own countries in there. So what do we do then? So in the short term, of course, what we advise these countries to do, our countries to do. One is, and I think you are at the forefront of this, and so it's really, really important for us to have this conversation. I think the most important thing to do is to make sure that you don't lose the gains that you made in the last few years. These countries have dealt with 4 really, really severe shocks in the last 20 years. Really, really severe shocks. And this is the 5th one. And in that period, there have been a lot that has been gained in terms of experience, in terms of policies that have been put in place, in terms of building resilience, and so on and so on. So that must be the primary things to protect the gains that have been made. That includes making sure that you do everything you can to make sure inflation doesn't get out of control. Because if that happens, if your macroeconomy becomes unstable, it's going to be very difficult. It will be very costly to bring that under control. You will have to do a lot of really, really, really painful things to bring it under control, including shrinking the economy. And that's something that is not a good idea. So making sure that now you do proactive, action to control inflation is important. So that's the first. The second thing is, it's really, really important to protect the basic services that are really, really the lifeline for poor and vulnerable populations. These basic services in health and education, but also, food security for the vulnerable people, right? Target as much as possible. I know that it is easy to say that, but not easy to do, right? But on the other hand, if you are forced to basically provide generalized subsidies, make sure that they're temporary, okay? There might be a case to be made that, okay, look, even the middle class actually needs some protection. And therefore, the targeting part is not necessarily something that, should be ironclad, even though that's preferable. But if in fact there's a much larger group of people who are affected by this crisis that need some protection, you might say, okay, general subsidies may be the thing to do. Just make sure that they're not permanent. Because if they're permanent, then you're undermining your macroeconomic stability, especially your fiscal policy, right? So that's basically the recommendation we make here. The third the third recommendation we make is to make sure that there is, the countries position themselves for a quick recovery once the crisis is over. So what does that mean? That means you do these things that have long been delayed, that don't cost a lot of money, but will actually be very, very important for recovery. So, example, business-friendly reforms, right? So that's one. It's not that complicated. That could be tax reforms, it could be regulatory reforms, it could be institutional reforms, and so on, right? So it's just like providing information and signals to, economic actors to take advantage of these new, these new changes. Second, even after you protect the basic service, spending on basic services, there is always going to be discretionary amount of money left in spending. And so the question becomes, how do you use that? And the most, the most important advice we can give here is that it's really worthwhile to reallocate the non-protected spending to growth-friendly investments. So there is always some scope for reprioritizing the composition of spending that is not already protected, okay? And that matters actually for long-term recovery, because in the long term, what you want to do is to invest in these foundational infrastructures that are going to increase the competitiveness of the economy, economy-wide competitiveness and productivity growth. So, cheap, reliable power, skills, financial, health, quality infrastructure in terms of roads and so on and so on. And of course, building regional value chains, right? Like the crisis that we've gone through, whether that is COVID or war in Ukraine or the war in Iran now, really makes the case. They literally make the case for themselves, right? The value, the importance of building regional value chains that are resilient to these shocks, whether that is in energy, in food, in fertilizer, in medicines, right? So I don't think I need to make that case that forcefully, because I think the crisis basically lay bare the importance of that. And then, of course, the long term also includes, naturally, making sure that industrial policies work in Africa, okay? Now, that takes us to the second part of the presentation. So Africa actually does industrial policy. So it's not that they haven't been doing industrial policy. The important thing is how to do it, how to make sure that it works. All right, this graph shows you that there has been a huge surge in industrial policies lately. For rich countries, it is mostly driven by geopolitical competition, reducing vulnerabilities in supply chains, and of course, gaining industrial capacity that have been lost, right? So those are the main motivations. For Africa, the main motivation is really just new products, new investments, and jobs. That's the main, that's the main motivation. Now, so African countries have been doing industrial policy. So the question is, have they worked? And if not, how do we make it work? And I think that is primarily the purpose of this report. So the second part of the report focuses specifically on that question. That you do industrial policies, how do you make it work? This is a quick look at what we actually see in terms of what countries around the world do, right? When you look at sub-Saharan Africa, the industrial policy tools are mostly border-related trade instruments, right? These are mostly import bans or import tariffs, import bans, export bans. So trade-related. 60% of the industrial policy interventions in Africa are basically these trade-related investments, tools. By contrast, look at the rest of the world. The rest of the world, 47% is subsidies. And for Europe and Central Asia, 63% is subsidies. So why is that? The main reason is it's not because African countries actually like doing these trade policies. That's not the reason. It's not a preference. The reason is because they're constrained. It's not necessarily the first choice that they will pick. It's that they're constrained. And the constraints are fiscal space, right? So when you provide subsidies, you're spending money. When you do import tariffs, you're gaining revenues. So a lot of African countries don't have a lot of fiscal space, so they'll rather gain revenues than actually spend. They don't have money to spend. So there is that. A lot of it is, the constraint is that they're not large economies in terms of population or even the size of the economy. So, the market size matters. And then there are a lot of countries that don't have bandwidth. This stuff requires, doing industrial policy right requires a lot of skill, a lot of ecosystems, in terms of, energy supply, logistics, skills, finance, standards, right? So ecosystem readiness, that's an issue. A lot of it requires a dense ecosystem of industrial products, which allows you to move to the next stage, right? And then there is also the resource endowment on which you can anchor. So if you look at all these 6 dimensions, that's what tells you, these are the things that tells you why African countries choose what they choose and not what will actually be considered as first choice instruments for industrial policy. So what we did was to look at specific kinds of, we looked at that set of constraints and looked at what is possible given a particular context. And we have 6 archetypes of countries. I'm sure there'll be more, depending on how you play around with these 6 dimensions of constraints. So I encourage you to go ahead and do that. But I'm giving you an example here. I'm giving you an example here where a country doesn't have a lot of fiscal space, right? They don't have a lot of bandwidth to sustain industrial policy instruments for a long period of time to support that. They are small. They don't have a lot of supply of cheap, reliable, abundant energy, or there aren't the skills and so on, right? That ecosystem is not there. The industrial base, that's the product space position, industrial base is very shallow, and they don't have any resources, right? So this is really like a constrained environment. So what can you do? And we lay out some of the things you do here, okay? So this is obviously a country or a context where industrial policy tools are really not useful, okay? And so what is important is to invest in the ecosystem, in the foundations that allow for all kinds of businesses to make sure that, in fact, they have the necessary infrastructure to be able to compete and to grow and to increase their productivity, right? As the economy begins to expand, then you actually have some more targeted kinds of instruments that you can use. But at this point, that is not, that's not feasible, right? So that's just one of the lessons when you do this kind of assessment. The second is a country that has natural resources. Its fiscal space is medium, low to medium, and it has some kind of bandwidth in terms of implementation. In that case, you could do things like export restrictions. So you could do export bans, right? But there is a huge caveat here. And that caveat comes in 2 forms, right? The first one is you should do this only if you have market share, global market share, okay? So for example, we looked at the case of Indonesia. Indonesia is this country where everybody talks about as having been very successful in actually, banning nickel exports and built an industry around nickel. So, but what people forget is that Indonesia has 60% market share in nickel. So it was able to actually do this, right? The companies don't have it, companies that want to process nickel and want to sell nickel-related products have nowhere else to go. There are not too many places they can go. So they basically have to go and locate in Indonesia. But Indonesia also tried the same thing with bauxite. And since it doesn't have market share, that did not work. Okay? The companies just left and they came to Guinea and got their bauxite from Guinea, right? So you have to be very careful when you do this. When you have a natural resource, you have to be, and you decide that you want to process domestically and therefore you're going to ban the export. You have to be careful. You have to be clear that first you have market share, and second, you have to make sure that you have the ecosystem to do the processing, energy, skills, capital, logistics support, to be able to produce at cost and be able to compete internationally so that you can get market share internationally, right? If you don't have those 2 things, be very careful because it could be very costly. In any case, so this is another, you can see a lot of other things that is possible, and then other things that are not good to do, things to avoid. And then here is here's another case where, in this case, so this is a country that has an industrial base, has its ecosystem is actually ready. It has a large market share. It has implementation capacity. It has fiscal space, but it doesn't have natural resources, right? So this is more like an industrial, a country that's already an industrial, that's already industrialized. So in that case, then you can really have targeted things like R&D tax credits, right? That rewards firms for increasing research spend, that they can innovate, that can get into new products. Okay, you can think about supplier development programs. You can think about green, you can move to like completely new greenfield technologies like green hydrogen, battery technologies, right? And so on, right? So there are lots of stuff to do here. There are not a whole lot of countries in Africa that are like that. So, one that comes to mind, of course, is a country like South Africa, maybe a country like Mauritius, but there are not a whole lot of them. But in any case, those countries that think that they're here can do these kinds of things. What is really not good to do is to start protecting activities that already have lost comparative advantage, right? So these sectors that have lost competitive advantage, try not to spend a lot of money trying to protect them, right? That makes very little sense. Or even just not having competitive ecosystems, such as letting large firms capture industrial subsidies as margins, right? Because they're not going to innovate, right? So you kind of want to avoid those kinds of things. Okay, so last point. So what does this all mean, right? And I encourage you to read the section in the report. What this means is, industrial policy is very hard to do and very hard to implement, okay? So it's really, really important to do it sparingly, okay? And if you do that, if you choose to do industrial policy, focus on capabilities, build capabilities in the economy, right? Build capabilities of businesses and companies and enterprises within a sector or within the economy. Do not pick a single company as a winner and then invest all the public resources there. Do not pick a product, okay? So instead, you want to pick a way of doing things such that, in fact, all kinds of things that haven't been anticipated can be created. So that's the first thing. Second, that because it is hard to do, you really need to have a lot of stamina. You have to have a lot of resources to support this at sufficient scale, sufficient levels of, duration of time, and a lot of discipline in order to be able to have time when to exit, and, condition support on performance, such as, export performance or good quality jobs or innovation, whatever it is. Like, make sure that you have these monitorable mechanisms, observable, monitorable indicators for actually linking support and duration. Third, do not forget ecosystems. Ecosystem is really, really important. Power, skills, finance, quality infrastructure, and so on. And finally, to overcome this small market size, regional integration and enlarging the market size is really, really important. So this is why we keep coming back to the African continental free trade. And it's because we really, really believe that that is the thing that is going to unlock prosperity for the region. A region that doesn't trade with its neighbors, with itself, is not going to actually develop that much over the long run. So that's why we do this. With that, I want to stop.